Jerome Powell has been leading a policy change in interest rates that has already led to a crash of 20% in the S&P 500 and nearly a 30% decline in the Nasdaq 100 year to date, since the policy shift was first signaled by the Federal Reserve. This shift in attitude from Powell began occurring in December of 2021, when he admitted that the Federal Reserve no longer believes that inflation is transitory. Since then, he's been guiding the Federal Reserve through an aggressive series of interest rate hikes. This hawkish policy change in interest rates from Powell has been putting major pressure on the stock market for all of 2022 and may likely cause stocks to crash further if the economy slows significantly. The Federal Reserve has been trying to achieve what's called a soft landing with the rate hikes. A soft landing is where the interest rate changes are able to decrease inflation without significantly hurting economic growth and employment rates in the economy. However, Jerome Powell recently acknowledged that there is a risk of a recession from the interest rate hikes and implied that it's a risk that the Fed is willing to take. In a recent briefing to Congress, Powell said that, quote, "We're not trying to provoke and don't think that we will need to provoke a recession." And then he added, "But we do think it's absolutely essential that we restore price stability, really for the benefit of the labor market as much as anything else." End quote. He also described the Federal Reserve's commitment to fighting inflation as unconditional. At a recent conference of central bank chiefs, Jerome Powell and central bankers in the Eurozone even expressed concerns that the low inflation forces we experienced in the past may not be coming back. He noted that forces like globalization, technology development, and aging demographics in the past had helped to keep inflation in check, but the global changes occurring in the aftermath of 2020 have made it unclear if these forces will be enough on their own to keep inflation low like they have been in the past. European Central Bank President Christine Lagarde agreed with Powell, adding that she didn't think, quote, "that we are going to go back to that environment of low inflation." This recent messaging from Jerome Powell has many market analysts cautious about the direction of the stock market in the near term, and warning that stocks could crash further since the Fed is indicating that it will continue to raise interest rates and do what it takes to fight inflation. This commitment to a high rates environment will put more pressure on stock prices and the economy. The goal of Powell and the Federal Reserve has been to slow the increases in inflation by using target interest rate changes to indirectly control the amount of borrowing and spending taking place in the economy. Borrowing and spending have large impacts on inflation and economic growth, so by raising interest rates to decrease borrowing and spending, the Federal Reserve hopes to cool inflation. Low interest rates incentivize people and businesses to take out loans for different business investments and other economic purchases, since they will be paying much less in interest payments on the money that they borrowed. Since more people are borrowing money and using it to purchase things in a low rate environment, this creates higher demand in the economy, and if suppliers aren't able to keep up with the demand increases, they start to raise their prices to decrease the amount of people trying to buy their goods and services. This increased pricing from tight supply being unable to keep up with high demand can help increase inflation throughout the economy. And this is what occurred. The Federal Reserve kept the target federal funds rate close to a range of 0% to 0.25% in March of 2020 due to the economic shock and uncertainty of the events from 2020. This near zero rate environment created major demand, though soon after, in the economy, as the cheap debt financing plus the stimulus payments given by the government created a spending boom in consumer demand that was combined with the supply chain disruptions from the manufacturing shutdowns and this combo contributed heavily to the high inflation. The Federal Reserve believed that the increased levels of inflation were temporary and would eventually subside, with Jerome Powell famously describing it as transitory. However, after sustained inflation for over a year, the Fed has completely reversed course and admits that inflation is now at risk of being sustained if they don't quickly start raising interest rates to slow demand in the economy and stop price increases. Jerome Powell and the Federal Reserve aren't the only central banks fighting inflation either. Inflation has been widespread across the globe, and other central banks have been forced to respond as well, with more than 80 countries' central banks having hiked their own interest rates this year. This tightening of economic conditions across the globe has increased fears that we might be facing a widespread global recession in the world's economy, since the rate hikes are happening all at the same time this year throughout the globe. But what do you think about the interest rate hikes and the economic direction? Do you agree with Powell's rate hike commitments to fight inflation, or do you think that the risk of an economic recession is too great? Let me know in the comments below what you think, and be sure to like the video and subscribe to the channel for more finance content. Thanks.